Most financial plans are built backwards. You, however, did everything right. You saved for decades, you hired a professional, you followed the advice that you were given. So here's what's hard to hear. If you have between $2 and $5 million saved, there's a very good chance your entire financial plan was built on a 5-minute questionnaire. And that one form is quietly costing you hundreds of thousands of dollars in the wrong risk at the wrong time. Here's the part that should bother you. Your advisor probably handed you that form thinking it was protecting you. It wasn't. It was protecting them. Let me show you how this works, because it shows a fatal flaw in many retirement plans. Before anyone talks about what you actually need your money to do, you get this questionnaire. On a scale of 1 to 10, how do you feel about risk? If the market dropped by 20%, would you hold, would you sell, would you buy? A few minutes later, out comes a label: conservative, moderate, aggressive. And that label gets matched to a pre-built model in the portfolio that everybody else that advisor is working with has. That's the plan. That one form is now the foundation your entire retirement is sitting on. And now you look like just 5 dozen other clients that advisor has. No customization, just blanket recommendations. Now I want to show you why that's exactly backwards, because there's one question your plan should have started with instead, and it almost certainly didn't. Once you hear it, you won't be able to unsee it in your own plan. I'll give it to you at the end. I'm Ryan Knoll, and I'm the founder of Nav Wealth Partners. We work with families who've already done the hard part, the ones who have saved millions of dollars. They've built real wealth on the backs of hard, well-fought careers. And what I've learned, sitting across from hundreds of them, is that the plans they walk in with are almost never wrong because of bad math. They're wrong because they started from the completely wrong end of the financial planning process. Stay with me to the end, because the fix has a name, and it changes how you look at every portfolio you'll ever be shown. So let's name what's actually happening here, because chances are it's probably happened to you at least once or twice, especially if you've worked with multiple advisors. I call it the risk score trap. Here's the trap. Your entire financial life, your income, your tax situation, your timeline, what you want to leave your kids and their kids, and the charities you care about, how long your money has to last. All of it gets compressed into a single number, a risk score. And that one number decides which off-the-shelf portfolio you get dropped into. Think about how strange that is. 2 people can answer the questionnaire in the exact same way, a same moderate score for 2 different people, and have completely different lives. One needs to pull income next year. The other doesn't touch the money for a decade or more. One has $2 million sitting in a pre-tax IRA that's a ticking tax time bomb, and the other has it all in Roth money. It's the same score, the same model portfolio. Totally different realities between these 2 different clients. And the questionnaire can't see any of it because it was never designed to. It was designed to sort you. It's just a single function. What you put in, it spits out one of 5 or 6 different portfolios that the firm tends to run, and then you're stuck with that the rest of the time you're working with this firm or that advisor. And here's the part that should bother you. That sorting isn't really built for you. It's built for scale, but not for scaling your account, scaling the advisory business or the advisory firm for which that advisor works. A firm managing thousands of households can't hand build a plan for each one. So they reduce you to a number and slot you into one of a handful of models. It's efficient for them. The question is whether the most important financial decision of your life should be optimized for their efficiency. And before we move on, I do want to say something. Models do have their place for people who are still accumulating and need help allocating those investments to a well-diversified portfolio. A model tends to do well, or a model can be a great starting point for a portfolio that needs customization beyond it. So 70-80% of somebody's assets could be in a model, and the other 20 or 30% should be positions that are different from what that actual base model is that need to be managed around, whether it's for tax implications or for diversification purposes. But when it's just the model and that's what your entire retirement's based off of, that's where it's wrong. So let me give you the clearest way I know how to see how backwards all of this is. Imagine you get in a car for a long trip. You open your navigation system or your iPhone and you plug in where you're going, And before it does anything else, it turns to you and asks, on a scale of 1 to 10, how much risk do you want to take on your trip today? And how fast should we go? You'd probably think that something was broken. That's not your job to answer. You don't know the roads, the traffic, the weather, or the construction. What you know is where you need to end up and when you need to be there. The navigation's entire job is to take that destination and engineer the best route to it, accounting for every condition you can't see. It calculates the risk. You don't guess at it. Now hold that up against your financial plan. When an advisor hands you a risk questionnaire, they're asking you to do the navigation's job. They're asking you, the person who doesn't do this for a living, to determine how much risk you should carry when the entire reason you hired them was to help you answer that question for you, based on where you're trying to go. You're being asked how much risk you want, when the real question is how much risk your destination actually requires. Those are completely different questions, and only one of them matters. You might be wondering, yes, this is why I named the firm Nav Wealth. I believe it's our firm's job to first figure out where you are trying to go, and only then can we figure out the most efficient way to get you there, and it's not with a preset model. So let's be precise about what that questionnaire actually gets wrong. And before I do, I want to be clear. This isn't some fringe opinion of mine. Some of the other most respected technical voices in financial planning have been saying for years that the single risk score is broken. This is close to consensus among the people who study this for a living. 3 things are wrong here and they compound. First, that one number is secretly 2 completely different questions mashed together into one. And the averaging hides the truth. And here's what I mean. Buried in that question are really 2 separate questions. Question 1, can you afford to take risk? Do you have the time, the assets, the plan to recover if something goes wrong? Then there's your capacity, and that's question 2. Do you want to? Can you actually stomach watching your account drop? That's your tolerance, because if you can't sleep, or you get sick, or you're in a bad mood because the market's down 10 or 20%, that's a good gauge of what your capacity actually is. But the score, it's adding these together and hands you a single label. And in averaging it, it buries the most important truth of it all. Just because you can afford to take risks doesn't mean you need it. A lot of you watching are already funded. Your plan doesn't require the risk you're being handed. You could take it, sure, but you don't need it to reach your goal. The score can't see that because it added the 2 numbers together and threw away the part that should have protected you. And notice what it's really measuring underneath: volatility. So how much your account bounces around due to what's going on in the market. When your actual risk is running out of money or being forced to sell in a downturn, it measures the feeling. It ignores the outcome. Second, it's a snapshot of an emotion. You answer those questions based on how you feel that week. Ask someone their risk tolerance after 3 green years and they're aggressive. Ask that same person 3 weeks into a crash and they're conservative. Nothing about their actual life changed, only their mood did. But that mood got frozen into a portfolio that's supposed to last 30 years. You built a decades-long structure on feeling you had on a Tuesday. To give you an example in my personal life, that might be me answering a questionnaire the day I come back from vacation. I've just been at the beach with my wife for the past week, and I'm in a great mood, ready and rejuvenated to get back to work. Somebody calls me with a questionnaire, I'm probably going to feel pretty optimistic. Now, if somebody calls me, the day that 2 or 3 of my 4 kids are driving me nuts or not going to bed on time, and I'm not in quite as good of a mood as I was when I was on vacation, I might have a completely different outlook on that questionnaire just based on my mood that day. It all depends and it all fluctuates. Now then, there's the third reason, and this is the one that's most expensive for your household specifically. It completely ignores taxes. A risk score has no idea whether your $2 million is in a pre-tax IRA, Roth money, non-qualified funds, and annuity. It has no idea what your RMDs are coming or what your withdrawal sequence could swing your lifetime tax bill by, and oftentimes that's 6 figures or more in retirements for people with a few $1 million saved. It can't because it's a risk tool, not a plan. So you get a portfolio built with zero awareness of the single biggest controllable cost in your retirement. That's not a small gap. For a $2 to $5 million household, That's the whole game. Now, I'll be honest with you about why this system persists, because it's not a conspiracy, and I'm not trying to pretend the people using these tools are villains. The truth is, the questionnaire makes the advisor's life easier. It's fast, it's scalable, and this is the uncomfortable part, it provides cover. It's a CYA for them. If the portfolio underperforms, the advisor can point to the form and say, well, this matched your stated risk tolerance, you signed it right there. The number becomes a scapegoat. I've sat across from too many people who got burned by a plan that was technically suitable and completely wrong for their actual life. That's the thing that genuinely frustrates me about this part of the industry. The tool that's supposed to protect you is often the one thing that's protecting everyone but you. If you're watching this thinking, I have no idea what my plan was actually built around, that's exactly the review my team does. We start from your real numbers, not a score. 30 minutes, your actual situation, and you leave with a clear picture of whether your portfolio is built around your life or around a label that's just protecting someone else. There's no cost. The plan is yours to keep. Links in the description. Now let me show you what this looks like when it goes wrong for a real couple. So these are composites of clients that we see come in every day. The names are changed, but the story tracks a similar theme that we see. A couple came to us. They're both age 63, about $3.5 million saved, a year from retirement. Their previous plan called them moderate, or it gave them a risk score somewhere in the ballpark of 50. Standard 60-40-ish model portfolio, same one the firm gave hundreds of other people. On paper, it was reasonable. And I want you to watch this part as if it were your own plan, because the setup is incredibly common. Here's what that moderate score never accounted for. Almost all of their money, about $2.8 million, was in a traditional IRA, a tax time bomb if they don't do anything about it. They needed to start pulling income in 18 months. And they had a narrow window before RMDs to do Roth conversions at lower rates. None of that. The income timing, not the tax structure, not the conversion window, none of it existed anywhere in that risk score. The portfolio was built to match a feeling about volatility, while the actual defining features of their financial life were invisible to it. And these were the ones that were going to add real dollars to their account if they had a plan for it. So picture your own situation in their seats. What did that cost them? Because the plan was built around a label instead of their income timeline. They were positioned to potentially sell growth assets in a down market to fund early retirement income, the exact sequence of returns risks that does real permanent damage. And because it ignored the tax structure, they were on track to walk into their RMD years with an unmanaged pre-tax balance, pushing them into higher brackets for the rest of their lives, and even higher if one of them passed away early. The moderate label felt safe. The actual plan underneath it was carrying risks the questionnaire couldn't even name. Easily a six-figure swing over their retirement, but don't worry, if they question their advisor or their firm's compliance department, all they would say is, hey, you signed this document, it's exactly what you signed up for. And that firm, that advisor, well, they would be covered. That's one of the things that's so wrong with this industry. It tries to reduce the most important people in it, the clients like you, down to a score that it can justify if they're ever questioned on it. The fix here wasn't a different risk score. The fix was throwing out the risk score first approach entirely and building from the other end. There is a place for a risk score, but it should not be the centerpiece of a whole plan. Which brings me back to the question I promised you at the start, the one your plan should have opened with and almost certainly didn't. It's not how much risk can you tolerate, it's this. What does this money actually have to do for you, and when does it have to do it by? That's the whole reversal. We call it destination first planning, and it works exactly like the navigation. You start with the destination, the income you need for how many years you think you'll need it, with a little buffer at the end. You also want to factor in the taxes you'll owe along the way and what you want to leave behind to your loved ones. And you engineer the portfolio backwards from that. The risk you take isn't a number you picked on a form based on your mood. It's the precise amount your destination requires. No more, no less. Sometimes that means taking less risk than a questionnaire would have assigned because you simply don't need it to reach your goal. Sometimes it means structuring the accounts for taxes first and letting the allocation follow. But it always starts from where you're going, not from how you feel about the ride. When you build it in that order, the whole thing changes. Your portfolio is tied to your actual life instead of a label. Your withdrawals are sequenced for taxes, and you stop carrying risk that has nothing to do with your goals. Risk you are assigned by a form, not by a plan. So what does this look like in practice? Well, I recently produced a video called Stop Trying to Time the Market. In it, we go over the strategy we use here at Nav Wealth for managing assets and the corresponding risks. For the full breakdown, go check out that video. I'll give you the Cliff Notes version here though. First is to start with the income you need, and let's just say it's $100,000 a year. Now you want to put that $100,000 into buckets, and we have 3 of them here. Bucket 1 is 12 to 24 months of income, so 1 to 2 years. So somewhere between $100,000 and $200,000 in assets for the person who needs $100,000 a year. This should be in cash or cash equivalents because you're going to spend from here. Bucket 2 is another 3 to 4 years of income. In this case, $300,000 to $400,000. The more aggressive you are, the closer you're going to fall to the smaller amount. This is invested then in short-term treasury CDs or even fixed annuities with guaranteed rates that are higher than what you can earn after tax on the CDs or treasuries. The idea here is to earn a bit more than the cash positions in bucket 1, but still not take on market risk, because as bucket 1 depletes, you're going to refill it with money from bucket 2. Then bucket 3 is your growth assets. This is the rest of your portfolio, a well-diversified stock portfolio for long-term growth, which helps you to keep beating inflation for the long run. This money then refills bucket 2 after bucket 2 refills bucket 1. In the other video, I have exact rules as to the flow of the replacement. So go check it out. I don't have time to cover it on this video, but I have about a 10-15 minute walkthrough on the other one. It's worth it if this sounds interesting to you. But this is why this approach is a little bit different than just the risk score method. Let's look at 3 investors, one with $1 million saved, one with $2 million saved, and one with $3 million saved. Starting with the $1 million saved, this person would roughly have $400,000 to $600,000 in cash and bonds. So 40 to 60% of the portfolio. They have less capacity for risk because they don't have as much saved as somebody with more money. So they are in a relatively conservative portfolio. In all actuality, this is just illustrating a point. Someone with $1 million saved would have a very difficult time justifying a $100,000 withdrawal rate over the course of a 2 or 3 decade retirement. But I just want you to take the point away from this here. So once I get through the other 2 scenarios, I hope you understand what I'm trying to go through. Next is the person with $2 million, and they have the same $400,000 to $600,000 in cash in short-term bonds in the first 2 buckets. But that's only 20 to 30% of the overall portfolio, so a bit more aggressive than client 1. And the $3 million client has 10 to 20% invested in the safer portion of the portfolio. Essentially, what all these investors have, though, is 3 to 5 years of protected cash flow from market swings at varying levels of overall risk. The person with a bit more saved has a higher capacity. The next thing we would want to judge is their tolerance. So just because they have capacity doesn't mean they want to take that risk. This is just the starting point. So we start with this starting point and then tailor it to their individual needs and wants. And this is important, though, because the average bear market is about 12 months long, and the recovery is typically around 18 months. And there are outliers like the lost decade and COVID, but we use the average case because it's a good testing ground. So if you have at least 3 years of income needs in lower risk securities, you have a little bit of flexibility to wait out bad markets. If you have 5 years, you have a lot of time. That is not something a risk score can get you on its own. Perhaps it gets you to that allocation by accident, but it's never done as part of the plan. The next step is to allocate your overall allocation then by account type. I go over it in the other video more in depth, but at a high level, Roth is almost always aggressive unless it's the only thing that's left. When possible, you want to hold cash outside of the retirement accounts, and pre-tax funds are your most diversified bucket. So here's the takeaway. Most financial plans aren't wrong because the math is bad. They're wrong because they start from the wrong end, a risk score and a model portfolio, instead of from the one thing that actually matters, what your money needs to do for you. If your plan opened with a questionnaire instead of that question, it was built backwards, and it's worth finding out what that's costing you. If you want to see what your plan looks like, built from the destination back, your income, your taxes, your timeline, your capacity and tolerance for risk, that's exactly the analysis my team runs. your real numbers and a plan you keep, whether you work with us or not. The link's in the description, and if this changed how you see the risk questionnaire, subscribe, because next time breaking down the tax side of this in depth, how the order you withdraw from your accounts can swing your lifetime tax bill by 6 figures, and why your plan probably gets that backwards too. Don't let a label plan your retirement for you. I'll see you in the next video.